The cryptocurrency market is brutal right now. Look in any direction and you'll see red charts. Bitcoin has ended up in the red for 8 consecutive weeks, a record for the cryptocurrency, and Ether is at its lower point since 2020. While it's painful for crypto investors, this dive isn't entirely unprecedented. Cryptocurrencies are infamous for their volatility, and tempestuous economic conditions are bringing down not just crypto, but the stock market too. What is unprecedented, however, is the collapse of the Luna cryptocurrency and its associated Terra Luna stablecoin, aka USD. You may not have heard of USD before, or know what a stablecoin is, but it's a big deal. Billions of dollars in crypto wealth have been vaporized, sending shockwaves throughout the whole market. There are two intertwined stories here, that of the USD stablecoin and that of Luna, both of which are part of the Terra blockchain. The USD coin is designed to retain a value of $1 at all times, but it was depegged on May 9th, and has since fallen to just 7 cents. Then there's Luna, the centerpiece of Terra's ecosystem. Its value has collapsed in one of the most stunning crypto crashes ever recorded. The coin's price fell from $116 in April to a fraction of a penny at the time of writing. Such an implosion has been seen in small-cap meme coins in the past, but never for something the size of Luna, which had a market cap of over $40 billion just last month. This is historic for the crypto markets, said Mike Burrows, co-founder of crypto investments firm Fortis Digital. This is a defining moment for the space due to its size and impact in terms of the amount of people that lost substantial value. The Terra saga has bigger implications than the lost billions. It's brought up questions about similar tokens, namely Tether, and regulators across the political all have their eyes set on stable coins. Here's what you need to know. What's a stablecoin? To understand the crypto catastrophe, you first need to know what a stablecoin is. In essence, it's a cryptocurrency that's pegged to a more stable currency. The biggest such coins are Tether and USDC, which like most stablecoins are both tied to the US dollar. So if you have 1,000 USDC tokens, for instance, they can at any time be exchanged for $1,000. Stablecoins are integral parts of DeFi, or decentralized finance, designed to be ways for investors to hedge against the volatility of the cryptocurrency market. Say Ether's price is $2,000, a trader could exchange 1 Ether for 2,000 USDC tokens. If tomorrow Ether drops 50% to $1,000, those 2,000 USDC tokens would still be worth $2,000 and could be traded for 2 Ether tokens. When investors smell a downswing coming, they put their money on stablecoins like Tether, USDC and, until this week, UST. Stablecoins also provide the means for cryptocurrency loaning and borrowing, making them a foundational technology of DeFi. The UST coin, created by Terraform Labs, is different from Tether and USDC in a key way. It's not backed by actual US dollars, but rather is what's known as an algorithmic or decentralized stablecoin. Tether's US reserves have come under scrutiny in the past, with there being some conjecture over how many dollars it actually holds, but it's US dollar backed in principle. For Terraform Labs, the idea was that through a few clever mechanisms, plus billions in Bitcoin reserves, the USD's dollar peg could be maintained without it having to be backed by the dollar. A decentralized stablecoin is the holy grail of DeFi, said Cyrus Younesi, former head of risk management at MakerDAO, the group behind DAI stablecoin. The selling point of Bitcoin and Ether is that they're difficult for bureaucrats, politicians and central bankers to control, but their downside is price volatility. If you could take those assets, extract stability out of them and productize it, then that's huge, Younesi said. But it's not very viable. Terra, Luna and USD, what are they? Terra is a blockchain, just like Ethereum and Bitcoin. While Ethereum's blockchain natively produces Ether tokens, Terra natively produces Luna. In the days preceding the depeg, Luna was trading at $85. To create USD, you need to burn Luna. So for instance, in early May you could trade 1 Luna token for 85 USD, since Luna was worth $85, but the Luna would be destroyed, burned, in the process. This deflationary protocol was meant to ensure Luna's long-term growth. As more people buy into USD, more Luna would be burned, making the remaining Luna supply more valuable. To entice traders to burn Luna to create USD, creators offered an insane 19.5% yield on staking, which is essentially crypto terminology for earning 19.5% interest on a loan, through what they called the Anchor protocol. Instead of parking your savings at a bank for a 0.06% interest rate, the pitch is to put your money into USD, where it can earn nearly 20% in interest. Before the depegging, over 70% of UST's circulating supply, around $14 billion, was deposited in this scheme. Here's the key to UST retaining its peg: 1 UST could always be exchanged for $1 worth of Luna. So if UST slipped to 99 cents, traders could profit by buying a huge amount of UST and exchanging it for Luna, profiting 1 cent per token. The effect works in two ways: people buying UST drives the price up, and UST being burned during its exchange to Luna deflates the supply. Then there's the reserves. Terraform Labs founder and CEO Do Kwon created the Luna Foundation Guard, a consortium whose job it is to protect the peg. The LFG had about $2.3 billion in Bitcoin reserves, with plans to expand that to $10 billion worth of Bitcoin and other crypto assets. If UST dipped below $1, Bitcoin reserves would be sold and UST bought with the proceeds. If UST goes above $1, creators would sell UST until it goes back to $1, with the profit being used to buy more Bitcoin to pad out the reserves. The depeg of UST. Over $2 billion worth of UST was unstaked, taken out of the Anchor protocol, and hundreds of millions of that was immediately sold. Whether this was a reaction to a volatile period, the rise in interest rates has particularly affected cryptocurrency prices, or a more malicious attack on Terra's system is a topic of debate. Such huge sells pushed the price down to 91 cents. Traders tried to take advantage of arbitrage, exchanging 90 cents worth of UST for $1 worth of Luna, but then a speed bump appeared. Only $100 million worth of UST can be burned for Luna per day. Investors, already flighty in the current gloomy market, flocked to sell their UST once the stablecoin couldn't retain its peg. It bounced between 30 cents and 50 cents in the week following the initial depeg, but has now fallen to a steady low of under 20 cents. Its market cap, which was around $18 billion in early May, now stands at $770 million. On the possibility of this being a malicious attack, some have speculated that an attacker attempted to break UST in order to profit from shorting Bitcoin, that is, betting on its price going down. If would-be attackers created a large position in UST and then unstaked $2 billion at once, it could depeg UST. Which would mean Terra's team would have to sell portions of its Bitcoin reserve to repeg the stablecoin. Once investors saw that UST lost its peg, they would then rush to unstake and sell their UST, which would require more Bitcoin reserves to be sold, adding further sell pressure. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go,